The Wall Street, just a name of a street in New York. Unlike the Oxford Street in London, which is filled with retail stores, Wall Street is filled with investment banks and other financial institutions like the hedge funds. The street got a very bad rep ever since the global financial crisis of 2008. Due to a lack of regulations and accountability, it had triggered one of the greatest disasters that many of us still cannot forget. But last week, a group of Reddit army took on a personal challenge against the street, giving a good squeeze to a hedge fund who held short positions in a company named GameStop. Let's just say there's been a lot of drama following on from that. Some people are loving the drama while some are hating it. And squeezed between the love and hate, there's a large group of curious people just sitting there trying to figure out what the hell is going on. It doesn't really matter where you fit in this drama. You might as well use this time to learn about something new, so that during those awkward dinner table talk, you can actually shake your head with a bit more confidence. So in this video, I'm going to explain what are hedge funds, what is shorting a stock really means, and why hedge funds do it, and finally, are hedge funds bad? Hey guys, welcome back. Hope you're all doing well. So hedge funds, they are simply like mutual funds, except they are not readily available like mutual funds to retail clients like me and you. We basically cannot go into our investing platform and buy units of hedge funds. However, they are available to institutional clients and other sophisticated high net worth clients for private investments. And that is simply because hedge funds actually come with a lot more risk plus a lot more higher fees compared to other mutual funds that are available to retail clients like me and you. So what do these hedge funds actually do? The word hedge simply means the way of protecting ourselves from any adverse situation or a loss. It typically involves taking an offsetting position to our current situation. We may not realize this, but we're all taking some form of hedging positions on our daily lives. For example, when you take out an insurance product on an electric item, you're hedging towards your potential future loss if that product stops working. Also, if you work full-time but have started to do a side hustle, well, you are also hedging against loss of future income. So everyone hedges. But when it comes to money and investing, the hedge funds give an alternative way of investing those money. They practically invest in various positions in order to hedge against certain events and circumstances. These positions are known as hedge fund strategies, and there are many of them out there. For example, merger arbitrage aims to review probability of a company merging with another company and market time the stock purchase in order to make a profit. Another very popular strategy is called event-driven, which invests in company going through a corporate change such as change in CEO. They invest in these companies where they think that the stock is mispriced by the market. Another type of strategy is called global macro strategy. They make investment based on the overall economic and political events around the world. For example, they would be investing in a way in order to hedge against US election or Brexit. And finally, we have the long-short strategy. This strategy is really the one that shook the market most recently. Melvin Capital is a hedge fund that employs this long-short equity strategy in their portfolio. And as part of this strategy, they had unfortunately taken a short position in a company called GameStop. So how does short selling works and why do hedge funds like Melvin Capital do it? Before I explain what taking a short position in a stock means, let's get long out of the way. When we buy a single stock, we naturally take a long position in that stock. Most retail investors like me and you, we usually refer to it as buying a stock or owning a stock. We do this with the hope that the stock price will go up in the future. And the opposite of this position is actually called a short position. With a short position, we want the stock price to go down in the future. However, the two main differences with a long and a short position in a stock is that when you are shorting a stock, you have to first find an investor who already holds that stock so that you can borrow it off them. And the second difference is that with a short position, you're actually taking an unlimited amount of risk where you can lose more than the amount you have invested, while with a long position, your total loss is capped at the total amount that you have invested. Let's do an example. Let's say we have an investor called A, and he likes to read a lot about what's happening to different companies and stocks in the market. Throughout his research, he found that a company called X is currently trading for £100 in the stock market, but he believes that the price of stock X will go down in the future, and so he wants to take a short position in stock X. In order to do that, he logs onto his trading account and talks to a broker. When the broker gets instruction from investor A that he wants to borrow stock X, the broker quickly looks into its own client profile and finds that investor B holds some unit in stock X. After finding a match with investor B, the broker tells investor A to deposit some money into his margin account. The initial amount of money that investor A has to put into the account is called initial margin, and that's typically a percentage of the total amount of money that he wants to invest, usually 50%. And at the same time, the broker also tells investor A that they must always maintain a minimum amount of money into their account for safety and insurance purposes. That minimum amount of money is a simple addition of the market value of the stock plus some maintenance margin. A maintenance margin is typically around, say, 30%. This works as a buffer or an insurance for the broker, just in case investor A can no longer give the stocks back to investor B. Do keep in mind that throughout this whole deal, the ultimate or the underlying true owner of stock X is in fact investor B and not investor A. And so if the stock do pay out dividends, the dividend income or the money will go directly to investor B and not investor A. And so in our example, we have investor A who's borrowing stock X, which is trading at £100 at the moment, from investor B, while at the same time giving a 50% initial margin and maintaining a 30% margin on his account. So on day one, when investor A gets hold of stock X, which is currently trading for £100, he immediately takes that stock and sells it in the market. When he sells it in the market, in return, he gets plus £100 in his own personal account. So this is how his account will look like on day one. He will have £50 as the initial margin, £50 because 50% of £100, we're assuming he's only buying or shorting one stock. So we have £50 here, plus the current market value of the stock, which is 100. So we have 100 here. So 50 plus 100 gives you 150. So this is the minimum amount of money that he must hold in his account as instructed by his broker. So this part is the market value of the stock, which is 100. And this was the initial margin, which is 50. For argument's sake, let's say that in day 2, the stock price does go down to say 50. Investor A then immediately buys back the stock with the price of 50, so he gets a minus 50 in his account and returns this stock back to investor B. And this way, investor A have actually made a profit of plus £50 because he sold the stock for £100 and bought it back for £50. Well, this is all well and good for investor A if the stock price goes down. However, what will actually happen if the stock price goes up? When the stock price goes up, remember it acts as a potential loss in investor A's account because he has to buy back those stocks that he sold so that he can return them back to investor B. So say for example, the stock price does not go down to 50, but instead it goes up to £120. This is when the broker gets worried and reminds the investor that he has promised he will maintain a certain amount of money in his account. So let's see what happens to his brokerage account when the stock price goes up to 120. So the stock value currently would be 120 and not £100. And he already holds an initial margin that he put into his account of £50. So it is there. We don't need to worry about that. But he has also promised that he will have a maintenance margin of 30%, which is 30% of the current market value of the stock, which is 120. So 30% of 120 is £36. Now the minimum margin is calculated as the current market value of the asset plus the maintenance margin. So we have £120 plus 36, which is equal to £156. But notice that £156 is more than £150, which he holds in his current account. And when this happens, broker will give a call to investor A, asking him to add an extra £6 in his account so that he can maintain the minimum amount of money that he needs to hold. And this is called the margin call. So as you can imagine, every time the stock price goes up, the requirement of holding a minimum amount of money in an account keeps going up, and so is the margin call, which keeps going up. And this is exactly what's been happening to Melvin Capital. When the stock price of GameStop kept going up, they had to maintain the margin call and had to add extra money from their own pocket into their brokerage account. This is essentially known as the short squeeze, which you would have heard quite a lot from what happened with GameStop and Melvin Capital. And remember that the price of a stock hypothetically can reach infinity. There is no upper limit on that stock. And so it is also possible for someone who is taking a short position to also have unlimited amount of loss. This is how the payoff function looks in a long and a short position. You have the return and the time. Say this was £100 of the stock that we're talking about. If you held a long position, or if you simply just bought stock X, then your return profile would look something like this, because the stock price can go up. So the maximum amount of gain you can make is infinity, and the maximum amount of loss you can make is essentially the price that you bought the share at, which is minus 100. So that's the total maximum loss you can make. However, if you take a short position in stock X, then the maximum amount of profit that you can make is essentially £100, and the maximum amount of loss that you can make is basically infinity. So you have 100 as a maximum gain and minus infinity as a maximum loss. The reason why you can only make £100 as a maximum gain is because if the stock price falls so much to say 0, then you don't have to pay any extra money to buy back that stock to return back to investor B. And so someone should really be shorting a position when they're absolutely sure of what they're doing, because very quickly the short position can really creep up into their brokerage account and lead to unlimited amount of losses. And this brings me to my final question of whether hedge funds are bad. Without taking sides, I just want to lay out some facts and points here so that you can actually make up your own decision. As explained before, hedge funds are a part of our overall financial ecosystem who are trying to maximize profit for their clients. And in order to do that, they take an alternative route and not the traditional routes of just holding a stock forever. And sure, there will be stocks that don't really do well. And as a functioning society, we cannot really bear the cost of these zombie companies. And so through natural means, some companies, just like humans, will meet its end. What we have to remember is that there are usually two sides to a coin, and that's how things balance. Coming back to hedge funds, it is also true that they tend to have a fee structure which can motivate them to take excessive amount of risk without a lot of accountability. And this is because hedge funds typically charges a performance fee of say 20%. So if the fund value goes up by 100%, they will take 20% share from that profit. While at the same time, if the fund value goes down by 100%, well, they're not going to give out 20% from their own pocket in order to make up for that loss. And so you can argue that they may be motivated to take more risk for higher potential return. However, also remember that most of these hedge funds also have their own money and career reputation at stake. And so it is not always possible to make this matter black and white. Tying back to this point, let's just assume that they are taking a huge amount of risk with their client money. But the question that we should be asking is that the way they are behaving, is that likely to impact the overall nature and the balance of the stock market and ultimately hit small retail clients like me and you? The answer is yes, they can have a massive impact if the hedge fund manages a lot of money, which can move a big part of the market. And the answer will be no if they only manage a small amount of money. Typically, size of individual hedge funds is much smaller than your typical mutual funds. Research by Boston Group Consulting highlighted that with nearly $100 trillion of assets that are being managed globally by all sorts of financial institutions, The AUM, or the assets under management within hedge funds community, is only about 3 trillion. So 3% of the overall money that are being managed. Therefore, you can argue that the size problem is not there. Although we did actually have a problem back in 1998 with a hedge fund called LTCM, Long-Term Capital Management, which was basically too big to fail and had a huge controversy around it. But the world have actually changed so much since then. And talking of change, my next point is around regulations, especially following the global financial crisis. All financial institutions, including the hedge funds, have been heavily regulated. For example, they were already regulated under Securities Act 1933, which only allowed them to raise capital through non-public offering and only from specialist high net worth client. And after global financial crisis, Dodd-Frank Act made it even stricter for these funds to raise money. And in the UK, FCA regulates the hedge fund industries. Since hedge fund managers are typically also investment firms, they are also governed by the MiFID II rules in the UK as well. Talking of regulations, it is also not true that a lot of investment professionals, including hedge fund managers, they can get away with illegal activity like market manipulation. For example, most recently, a hedge fund manager has been sentenced to nearly 12 years in federal prison after pleading guilty to committing securities fraud using false and misleading information. And another hedge fund manager, Daniel Kaminsky, founder of the Marble Ridge Hedge Fund, was also charged with fraud and could face up to 50 years in jail. However, even with all these regulations in place, a common trait with a lot of this hedge fund is secrecy. They're basically not required to fully disclose how they are making money. While this point can be seen as negative, of course, but what the hedge fund managers would say is that it is basically their secret sauce. Just the way Coca-Cola and KFC have their secret ingredient, which they won't reveal, hedge funds also do the same. So here you go. I hope this video provided you with some clarification around hedge funds and what shorting a stock really means, so that you can make sense of all the drama that's been on air over the last month. Well, that's all for today. Don't forget to like and subscribe to my channel. And until next time, look after yourself and your money.